Hi, this is David Dickens, and today we're going to talk about what is the right amount of life insurance for you. The ultimate answer is it depends on your life situation, but what we're going to try to give you is a little bit of a formula, a little bit of a roadmap to calculate just the right amount for you. I'll go get Walter, and we'll get started.
Welcome to another episode. I'm Walter Storholt, as always, joined by David Dickens, of course, Creative One Advisors Group. David is the president and wealth advisor there. You can find us online at creativeoneadvisorsgroup.com, serving you throughout the Kansas City area and beyond. And it is a great category of conversation today that we're going to be talking about the right amount of life insurance, because David, this has been a topic on my mind after having a new addition to the family come along back in the fall. And as I've been kind of doing my, beginning of the year financial thought processes and planning and things like that, I've said, it's been a while since my wife and I got some life insurance, and I don't know if we have the proper amount before the kid, let alone now that we've got a kid. So,
well, good. I hope this is targeted for you, Walter. This is awesome.
Yeah, this is going to be perfect for me. But the beauty of this is you're not going to just talk about somebody in my position, but we're going to be able to kind of talk about wherever you are in your lifespan. You're going to kind of cover that ground a little bit for folks.
Exactly. So this topic really came up over the holidays. So we're January of 26. Came up over the holidays, two different conversations I had at two different settings. One was a 30-something who didn't actually know how much he had, and his wife had zero. And another one was a 50-something, looked to be mid-50s, so maybe 10 years from retirement. And he was questioning, do I even need what I have? So we had a nice chat. I thought, you know what? This is probably a good topic for our listeners. We have a broad variety of ages and economic positioning for our clients. So hopefully there's something in here just for you.
Sounds great to me. Where do you want to start?
Well, I think I said in my little intro that the answer is it really depends. It's not really age-based. It's more about your life situation, your current and your future financial obligations. But age is usually an easy way to break it down by examples. But the real answer is, who will be financially impacted by my death? If the answer is no one, then you probably don't need life insurance. If the answer is people will be really financially impacted by my death, then you got to focus and get down to some sort of a calculation you and everybody that is important to you feels good about. So the things to consider are, do you have a spouse? Yes or no? Is your spouse employed? So are you a two-earner family or a single-earner family? Do you have kids? How many? How old? How many years are they from maturity, from independence? Do you still have a mortgage? Do you have other debt? Hopefully not credit card debt. Maybe you do. Do you still have student loan debt, car loans? And then if you have kids, what's your plan for college education? If you're not there anymore, but your spouse remains, do you want to try to fund that? So that's kind of the framework around which you would build your calculation. Why don't we start with someone between the age of 0 and 25?
Okay.
I said it wasn't age-based, but this kind of helps us frame. You probably have a lot less people counting on you if you're between 0 and age 25.
Well, I like that. I can't wait to hear what's on the 0-year-olds' agenda and, who they need to be looking out for.
When you have new kids, you usually get a mailer from some life insurance company that says, hey, you should have some life insurance on your new kid. And there are probably good reasons for that. I just don't know of any good reasons for that. So anyway, the person in this category who I could see, if you're single, you're in your early 20s, you don't really have any financial obligations that, generally speaking, aren't going to die with you if you die tomorrow in a horrible accident of some sort. However, the one thing I can think of is, let's just say that you racked up some pretty decent student loan debt and your parents co-signed with you. In other words, you die, you're not going to earn another penny the rest of your life because your life is over, but the student loan debt survives because your parents were the co-signers. So that's a reason why, even if you don't fund it, maybe your parents would want to fund a life insurance policy on you. Well, how much would that cost? So I ran a real quickie little easy calculation yesterday as I was preparing for our conversation today. If you are 25 years old, you're a male, you're living in Kansas, you're in pretty good health, a $250,000 policy that lasts for 20 years. I'm going to unpack that here in just a minute, but it lasts for 20 years and then it goes away. That would cost you about 17 or 18 bucks a month, about 200 bucks a year. Let's say your parents are going to pay that, and they might say to themselves, we have 50 or 60 or 80 or $120,000 of student loans that we've co-signed for. Let's just take out a policy on that. Maybe you don't need $250,000. Maybe you need $100,000, and it's a lot cheaper. If you're female, it's not 200 bucks a year, it's 177 bucks a year. Why is that? Well, statistically, women live longer than men, and so the insurance company knows there's slightly less possibility they're going to have to pay out on this, so they're going to charge you a little bit less. Actuaries, they're really good at numbers, so that's how they price these things. Most of what we're going to talk about, especially in the first 2/3 of this podcast, is term life insurance. And there are two different types of insurance that are basically available to the consumer: term life insurance and permanent life insurance. Permanent life insurance almost always includes an investment component, whereas term life insurance is, you can think of your car insurance or your homeowner's insurance as term insurance too. You're just buying it for a year and then it expires, and if nothing happened, you didn't get anything for the premium you paid. You just didn't need to use it. And the same thing happens with term life insurance. It's the cheapest way to get just core insurance on your life. No bells, no whistles, no investment. There's nothing left at the end. If you buy a 5-year policy and at the end of 5 years, you flushed all those premiums down the drain. But if you died in those 5 years, the people that were counting on you really appreciated the fact that you made those premium payments. What I was going to say at the top of this, I have 3 clients that I can think of pretty much off the top of my head whose spouses died in their 30s or 40s. Now, 3 out of my client base may not sound like much, but if you're one of those 3 and you didn't have adequate life insurance, the people you left behind are disadvantaged. 2 of the 3 families that I can think of were underinsured for that person dying. So it's real. The chances are really small that you're going to die in your 30s or 40s or even 50s. But people do it all the time. The chances are small, and that's why the insurance doesn't cost very much. What you don't want to do is ignore the possibility that it might be you and leave your family in a bad situation. So that's 0 to 25. It's highly likely that you don't have an insurable interest, and honestly, I can easily make the case why you don't need life insurance. This is a good time to pause and say none of this is specific advice for you because we don't know your specific situation. But generally speaking, I think you'd have to dig pretty hard to find a really good reason to buy life insurance before age 25, unless you got married at 18 or 19 or 20 and you started having kids. Totally different. So That's the first kind of situation that is pretty easy to identify.
A lot of people, though, once they get beyond 25, life starts to get a little bit more complex, and I would imagine we can find a few more reasons for why insurance is going to be a little bit more popular in that age range.
We absolutely can. So I kind of refer to these as your peak responsibility years. Your peak earning years tend to be between 50 and 65, but your peak responsibility years tend to be between, let's just say, 30 and 50. So you got married, you've got a couple of kids, you got a mortgage. So there's some decent calculators online. A lot of them, they say, click here and we'll send you a proposal. Well, that's not a calculator. That's somebody trying to sell you something. But if you look hard enough, you'll find a couple of decent calculators. But if you just want something you can do on a yellow pad, here's what I do. Let's just say the situation is you're 38, your spouse is 38, you got a couple of kids, maybe they're 10 and 8 years old. Your family salary is $250,000. Maybe that's one of you, maybe that's both of you together. Let's just say that you have a $400,000 mortgage. Let's just say that these kids, you want to put them through college, but not Harvard. you want to send them to a really good public school that's going to cost you about $100,000 for 4 years. And let's say you got a $20,000 car loan, and for good reasons, you've decided that you need to replace 5 years of your earnings if you were to die tomorrow. So a $400,000 mortgage plus the $100,000 per kid, $200,000 for education, $20,000 to get rid of that car loan, because you want to leave your spouse in a good financial position when you leave this earth too early. And then you said you wanted to have 5 years of salary replacement. That's 5 times $250,000 or $1.25 million. If you add all those things up, you come up with $1.87 million of insurance. But you also have $40,000 of savings sitting down there at your bank or your credit union. And you've already put away $30,000 in some 529 plans. Arguably, but in my mind, yes, you should subtract those from the $1.87 million you're going to need. So really, your life insurance need is $1.8 million. And that calculation assumes that you are a single earner, that your spouse stays home with the kids. And so you're trying to replace the entire $250,000 over that 5-year period. Now, some calculators I've seen online would say, what about inflation? And what I would say is you could build inflation into this $1.8 million calculation, but you're going to pay off your mortgage. When that check comes from the insurance company, you've lost your spouse, a month later, a check shows up in your mailbox. You're very likely to just go pay off that mortgage. You're very likely to go pay off the car loan. And then your kids don't go to college for 6 or 8 or 10 years. And you don't need the salary replacement immediately. So you're going to invest that money. And even if you invest pretty conservatively, I called it moderately conservative here in my notes, that rate of interest, that rate of earnings should be equal to inflation. So in my thought process, I don't really need to build in an inflation factor on top of the 1.8 million that I've calculated for how much life insurance I might need as a 38-year-old. So in that situation, you're really concerned about mortgage, college, and getting your spouse back on their feet. Another thing to look at here is if you're not paying down that mortgage every month, replacing fully a $250,000 salary is going to have a lot of money left over at the end of the month because you're not paying a mortgage anymore. The mortgage is paid off. So whether you feel like you need 3 years of salary replacement or 10 years of salary replacement or 20 years of salary replacement, that's a personal decision. But I'm pretty sure you don't need 0 years of salary replacement. Let's just say a little quick twist here. Let's say that you are the sole breadwinner in your house, but your spouse dies. And now all of a sudden, maybe your kids are not 10 and 8, maybe they're 4 and 6. Somebody that's going to not having your spouse there is going to significantly impact your day-to-day, your hour-to-hour life. And you would probably need to build in 2, 3, 4, 5 years of help with your kids. Maybe your mother-in-law lives right across a couple blocks away. And you say, well, I don't need them. I got my in-laws. But maybe they live in a different state and they're not going to move to you. So this is why it's not age-based. It is who will be financially impacted by your death. And in that case, even if you're the breadwinner is still there, not having your spouse around is going to cause you extra expense. And so a spouse that doesn't work outside the home, they might still have a need for life insurance because the people they leave behind will be disadvantaged in some other way. What does all this cost, Walter?
That's part of the big question. Yeah.
That is.
Not as cheap as that 25-year-old, I'm sure.
It is not quite as cheap. However, it's actually pretty cheap if you think about what the cost of not having it would cost. So I also ran a couple of calculations. What I did, I put this into a calculator that I have access to, and it shows me 20 different companies and how much they would charge you. So this one is a 35-year-old male living in Kansas, and they want $1.5 million on a 20-year term policy. Goes for 20 years. The premium stays the same every year, but after the 20 years, it just goes away. You don't have anything left. You didn't. So anyway, that's why it's inexpensive insurance. So in that situation, that 35-year-old male in Kansas wanting $1.5 million of coverage for the next 20 years up until age 55 would pay $91 a month. If that were a female, maybe she's the big breadwinner. Instead of $91 a month, it'd be $73 a month. Why? Because women live longer than men, and the actuaries know that a female is less likely to die at any given point than a male. So the guy is going to pay $1,000 a year or $1,100 a year. The female, for the same coverage, is going to pay a little bit less than $900 a year for the peace of mind of knowing that if they die tomorrow or any time in that 20-year period, the people they care about are going to get a check in the mail tax-free for $1.5 million, which is going to carry them a long way into normalizing their life when you're gone. So the costs, I think anybody that was listening to this podcast, if you have enough assets to be listening to this podcast, you would probably be saying, wow, that's pretty cheap. What you might also be saying is, wait a minute, that's cheaper than the policy I get from my work. And here's another pro tip of the day. When you buy a policy from work, it's easy. There's no underwriting involved. They take it out of your salary. But it's also going to be more expensive if you are in pretty darn good health. Because with a policy that just comes to everybody at work, they're going to insure everybody at work. They're not going to talk to your doctors. They're not going to look at your blood scans. They're just going to, you could be a walking time bomb and they're going to insure you. But if you go get it yourself, they're going to want a few doctor reports. They're going to send somebody to your house to draw a little bit of blood. And they're going to make sure that you're at pretty good risk. And for that pretty good risk, they're going to charge you less. So I won't encourage you to not get the insurance from your company. I won't do that. But what I will encourage you to do is compare. And it's pretty easy to compare. So make sure that you are getting the most cost-effective coverage that you can get based on the health that you're in currently. You might say another choice is, why a 20-year policy? Maybe I get a 10-year policy, or maybe I get a 30-year policy. Well, 10 years is going to cost you less, and 30 years is going to cost you more. Why? Because they're covering a different type of exposure. The insurance company is exposed differently. Why I like that 20-year, if I'm 35 years old, is it takes me to the point where I'm probably an empty nester, at which point I may not need life insurance at all because my kids are out of the house. They're up and running. We've saved a ton for retirement, and now I'm in my prime earning years, and we are fine. Or I may not need $1.5 million when I'm 55 and this 20-year policy expires. Maybe I do a $750,000 policy, save myself some money as an older guy, and right size my insurance coverage at that point. Now, that happens to be the third category that I want to talk about. But Walter, hopefully that made some sense.
It did. And I know as we turn the page to that next category, we kind of go back to where it all began, which was a lot of people, at least they're making the assumption now, well, now my responsibilities are lessened. Do I even need insurance anymore? Am I back to that 0 to 25-year-old range where there's got to be some real compelling reason for it? And so at least I feel like that's the assumption a lot of people have when they then get on the other side of a lot of those responsibilities.
I think that's right. And some people are. Some people aren't. So 50, 55, late 50s, somewhere in that range, you've probably become an empty nester. Hopefully, you don't have kids living at home, but maybe you do, and maybe there are good reasons for that. Maybe you've got a big, juicy 401k at work. You've been pounding away at that thing for years. It's been doing great. You've kept it, pretty fully invested in your young years. You're in your high earning years. Yes, probably, maybe. But you're feeling really good. You have a plan, and it's almost fulfilled, and you're only in your late 50s. On the other hand, maybe you're a little bit behind in your retirement savings. So that person I just described, maybe there's a reason to dramatically cut back on the life insurance you have because your insurable interest, the people who are counting on you, if you were to die tomorrow, that amount of money is way less because you've been killing it for the last 20 years. But maybe you're a little bit behind on your retirement savings. Maybe you still have a mortgage. Maybe you traded up at 52 and you have a bigger mortgage than you had when you were 30. That could be a reason to maybe purchase. So let's call it 55 years old. Maybe you're retiring at 65 and you need a 10-year level premium term policy. You might be a person who wants a whole life policy, which costs you a lot more because there is an investment, a savings element to whole life that there is not with term insurance. I've always been a buy term insurance and invest the difference type of person. But I know people who did it the other way and they came out just fine. I just have always separated my investments from my insurance because I like the flexibility. And so that's a decision you chatted over with an advisor or an insurance person of your choice. And that's a decision you'll have to make. But there's a really good reason why this person who's slightly behind on their retirement savings and still has a mortgage, that they might need to calculate how much of a 10-year level premium term insurance policy they might need. That policy is going to go away at age 65, but what they told us is, we're going to retire at 65. So at that point, maybe there's no insurable interest, no reason to keep paying. What you probably know, but I'm going to say anyway, is if you let's say you buy a 15-year term policy when you're 55, it goes to 70. You get to 65 and you say, I don't need that policy anymore. All you do is stop paying for it. There are no penalties. You didn't make any advance commitment to the insurance company to stick around till the end of the 15th year. You just stop paying it and the insurance coverage ceases to exist. But here's a different situation for that same person. Let's say you are mid-50s to early 60s and you're starting to think about long-term care. And you've looked at some policies which are becoming more few and far between because insurance companies are saying, wow, this is a crummy exposure for us to take on since healthcare is getting more expensive and people are living longer and a lot more people are needing long-term care. But you looked at some policies and you don't feel good about paying every month or every quarter or every year for the rest of your life for something you may never need and for which premiums, most of these policies I've seen, the premiums can go up. They just send you a notice saying, what we said last year, it's going to cost you more this year, or we can cut your benefit. What you might want to do instead, and I have a number of several clients who have done this to fund their possible long-term care exposure, is they buy a permanent insurance policy, a whole life policy, for the accelerated death benefit. And what an accelerated death benefit will do for you is, let's just say that you buy I'll get into calculating how much you might need this policy to be in just a minute. But what happens with an accelerated death benefit is if you get into a position where you have a terminal illness, what the insurance company will do, because you have this accelerated death benefit rider or component onto your policy, is typically what they'll do is send you annual payments, maybe monthly. If your death benefit is $500,000, an example of what they'll do is they'll send you up to 80% of that, $400,000, and they'll divide it by either 4 years or 5 years. What the insurance companies and actuaries know is if you have a terminal illness, you're unlikely to last 5 years. Now, if you have Alzheimer's, you might last 10. But if you have a terminal illness, you're likely to be in long-term care for 24 or 30 or 36 months. So they are happy to accelerate that death benefit, send it to you almost, I've never seen it where it wasn't tax-free, and you just pay for your long-term care out of that. So it's a different way to fund long-term care. And if you never need long-term care, your spouse or your beneficiary gets the death benefit when you die. So instead of paying for a long-term care policy that is use it or lose it, you're actually funding an insurance policy here that has a death benefit. And if you die 6 months after you take it out or 20 years after you take it out, start the policy. As long as you kept paying the premiums, somebody's going to get that death benefit. So that's an alternative that makes a lot of sense to a lot of people. Not use it or lose it, but there's something at the end for the premiums I've been paying. How much of a death benefit should that be? Well, that's a hard question to answer. But right now, long-term care in Kansas, Missouri, kind of a Midwest thing, is about $100,000 a year. And if inflation runs at, say, 5% a year, you're 65 and you're thinking, well, I might need this in my early 80s, mid 80s. So maybe 20 years from now, what is this long-term care going to cost me? Well, at 5%, the rule of 72 would tell us, which we've gone over in prior podcasts and easily Googleable if you don't know what the rule of 72 is. But the cost is going to double in about 14 and a half years. So let's just say that by the time you're 85, long-term care doesn't cost $100,000 a year. It costs $250,000 a year. So maybe what you're saying to yourself and your spouse is, we should have a policy that has a death benefit of $500,000. We don't necessarily want to insure away the entire cost of long-term care because it's kind of expensive, but we wouldn't mind offsetting a big chunk of it. And then we'll let our savings or our 401ks or et cetera take over the rest of it. And we don't know if somebody's going to be in long-term care for 6 months or 4 years. So maybe a $500,000 policy is exactly what you need. It's not whole life. I mean, it is whole life. It's not term. The problem with doing this with a term policy is the premium of a term policy goes up every year you keep the policy. Now, you could buy a level premium term policy, which has a much higher level premium. But at the end of the term, 10, 15, 20 years, you have nothing. Whereas with the whole life policy, you have something. So it gets a little complicated. This is probably not a decision for a do-it-yourselfer, but it could be if you're really good at it. But it is something if you're concerned about long-term care. This is another reason why a 55, a 58, a 63-year-old person might want to look into a permanent life insurance policy. So there might be a need. You might have an investable interest, an insurable interest at this age, whereas your easy to get to brain might say, I don't need my term policy anymore. So if you're concerned about how to fund long-term care, get some good advice. And it might include a whole life policy with an accelerated death benefit.
Great breakdown for those that are in those different life situations, kind of in that age range as well. But like you said, certainly a sliding scale on some of these things based on your overall life situation. You might be a very different 25-year-old or 50-year-old from your counterparts, in which case you're going to need some more customization, of course. But I think just putting some of these guardrails in place, some of these expectations, at least is going to help people, David, put their situation into at least some proper framework here. So it's a great first step hearing that outlay from you today. I think that's really helpful.
Good. Well, I got one more for us, Walter. We try to keep these podcasts at about 15 or 20 minutes, mainly because when I'm in my car, that's the entire length of my attention
You might be
span.
at a new record today, David. I'd have to go back and look at the archives a little bit. But
so here's what I'm going to do.
With one more still on the agenda, we may tip the scale.
I am going to hit this with such a light touch that you're going to be amazed. But I just want to say, I have a couple of clients. They're of required minimum distribution age, RMD age. They're over 73. They don't need these RMDs. So the government's making them take $25,000, $35,000, $50,000, $70,000 out of their IRAs every year, and they don't need that money. Or maybe they need a little bit of it, but they got $20,000 or $30,000 or $50,000 left over every year. What are they going to do with it? Well, they're not going to spend it because they already have ample spendable money. They put it in a taxable brokerage account, which is a perfectly fine alternative. But I have a couple who have put it into a permanent life insurance policy that has the same premium every year. They know exactly how much their heirs are going to get when the second of them dies. So it's called a second to die life insurance policy. The reason it's second to die is because it's the cheaper way. The life insurance company knows that they'll have to pay out later. They'll almost certainly have to pay out later if they have to wait till the second of the couple dies. So it's a cheaper way to fund a tax-free inheritance. You can name as many beneficiaries as you want. You can name your kids. You can name your grandkids. You could name your friend down the street. So why don't we wrap it up with that? Hopefully that is something those are a couple of uses that I see in my practice all the time for different ways to use different types of life insurance policies. There is not necessarily a right answer for you because your situation changes maybe on a somewhat regular basis. Marriage, divorce, kids, retirement, job loss, all kinds of things can affect the type and dollar amount of life insurance you should have. But for the vast majority of cases, I don't think the amount is zero, especially when you're in your peak responsibility years. So none of this has been investment or insurance advice for any particular listener, but hopefully you found something in here that fit your situation somewhat, and you find something actionable for tomorrow or next week.
Yeah, I think it's helpful, David. If this raised additional questions for you listening to today's episode, I definitely invite you to reach out and talk to David about those additional questions that have popped up now. 913-317-1414 is the number to touch base with the Creative One Advisors Group team. Again, 913-317-1414 or online at creativeoneadvisorsgroup.com. We've got all the contact information listed in the description of today's show to make life easy on you as well. But it's just a great opportunity to make sure that you're on the right track. Whether it comes to insurance questions like this, investing questions like we've talked about on previous episodes, like our past episode talking about figuring out if you're ahead or behind in your retirement savings. We cover a lot of different topics here on the show, and it's reflective of the kinds of conversations David has in the office. So don't hesitate to reach out if you've got additional questions about how you can best prepare for your financial future. David, thanks for taking the time to chat with us about all this today. Really appreciate that, and we'll look forward to catching up with you again soon.
We'll do it again in 2 weeks, Walter.
Sounds like a plan. For David, I'm Walter. We'll see you next time right back here on Cover Your Assets, KC.
Creative One Advisors Group has been proudly serving families in the Kansas City metropolitan area since 2003. Over the years, we've evolved to help meet the needs of our clients, becoming KC Financial Advisors in 2010. In November 2021, our advisory business was acquired by Creative One Wealth, LLC, C1W, and in January 2025, we officially adopted the name Creative One Advisors Group. Previous episodes were recorded under the branding of KC Financial Advisors, which has since been rebranded as Creative One Advisors Group. Any references to KC Financial Advisors should now be understood as referring to Creative One Advisors Group. Investment advisory services are offered through Creative One Wealth, LLC, a registered investment advisor. Creative One Advisors Group is a DBA of Creative One Wealth. Insurance services are offered through licensed insurance professionals. Investment advisory services are provided in accordance with the fiduciary duty of care and loyalty that includes putting your interest first and disclosing conflicts. Insurance services have a best interest standard, which requires recommendations to be in your best interest. Creative One Wealth is not affiliated with or endorsed by any government agency and does not provide tax, legal, or estate planning advice or services. Investing involves risk, including the potential loss of principal. No investment strategy can guarantee a profit or protect against loss. Neither asset allocation nor diversification can ensure a profit or guarantee against losses. None of the information contained herein shall constitute an offer to sell or solicit any offer to buy a security or any insurance product. Insurance product guarantees are backed by the financial strength and claims paying ability of the issuing company. The Creative One family of companies includes Creative One Wealth, LLC, a registered investment advisor, Creative One Securities, LLC, member FINRA SIPC, and a registered investment advisor, and Creative One Marketing, LLC. These companies share common ownership. Additional details regarding advisory services are available in our firm's ADV Part 2A and Form CRS.
Life insurance involves fees and charges, including possible surrender penalties, and is not right for everyone. It generally requires medical and often financial underwriting to qualify.